Hey everyone, thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report and its effect on financial markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. We've also recently launched a newsletter. If you want to check that out, check out the link in the description below, and we will be giving away one free subscription to ITC Premium every single month for that month. Let's go ahead and jump in. So, as of today, we had a new release in the Consumer Price Index, or CPI, and it came in higher than expected. Okay, so you can see here it came in 8.3% for headline CPI. Now, technically speaking, 8.3% is still less than it was last month. Okay, so if we think about year over year, it has actually gone down, and it has been going down for the last couple of months, where we saw at least a local top, hopefully a global top for a long time, on headline CPI at 9.1%. Now, I think the main issue in this release is that a lot of people were expecting it to come in lower at around 8.1% to really see it coming back down quickly. The problem, and we talked about this a lot over the last few months, is what does the Fed do if inflation does not come down quickly and it just sort of remains elevated at the 8 to 9% range? What are they going to do? They're going to be stuck with a difficult decision. Frankly, I mean, you have to figure out if they're going to keep raising rates into a slowing economy, or if they're going to let inflation run rampant. And I think that Powell has been very clear that their main focus is going to be continue to fight inflation and to get inflation closer back down to their target of 2%. And when he talks about inflation and the Fed's fight against inflation, one of the things that you'll notice, especially recently, is that he often quotes Volcker. And the reason for that is because, of course, Volcker helped get us out of the highly inflationary decade a few decades ago, and ultimately led to two brief recessions in order to get us out of it. But he did what had to be done, is sort of the point that I think that we need to take away from it. He did what needed to be done when it mattered most. And, despite all the people whining about it and talking about how the markets couldn't handle it and how it was killing the economy, he did it anyways. And ultimately, I think it turned out to be a good thing, because it got inflation back under control. And then just a few years later, we had a booming economy once again. You could argue, had he not gotten it under control, it still would have just led to very stagnant conditions, market conditions, for many more years to come. We're going to talk a little bit more about that later on in the video. But I wanted to sort of break this down a little bit. Again, consensus for this month was 8.1, and it came in at 8.3. Now, you might think it's not so bad, right? Like, it's not so bad, but they often, there was a lot of overestimates or underestimates when it was going up. It's not that bad to be off by 0.2%. But the real headline, maybe headline's not the right word because this is headline CPI, the real thing to take note of, and I think arguably what the Fed cares more about, is core inflation. And core inflation went up. You can see that it hit a local top, at least in March of 2022. And in April and May and June, it was dropping. But in July, it stayed the same. So if you remember back to last month, when inflation came down from 9.1 all the way down to 8.5, what was interesting, and we talked a little bit about this at that report, is that core CPI actually remained unchanged, showing that, hold on a second, maybe this isn't as clear as people are making it out to be. Now, you might wonder, what is core CPI? It basically is excluding the food and energy sector. Okay, so a lot of people might point to oil as being very high or coming down, or corn or wheat. But core CPI doesn't care about the energy sector, it doesn't care about the food sector. And so it's a measure of sort of the other baskets that we're tracking. And we also have seen a lot recently that one of the biggest things, I think, causing acceleration in the core CPI is housing. It's sort of a lagging indicator, and we know that housing is up significantly, and it takes a while for it to slow down. I think that there's a lot of evidence that it is starting to slow down, especially with interest rates now, going up to levels we haven't seen in quite a long period of time. But at the same time, it's a very lagging indicator, and it takes a long time for everything to be sort of reflected in the housing market. Regardless, though, you can see that the core CPI came in at 6.3%. Now, what's interesting is that peak core CPI was at 6.5%. We're not that far away, right? So it sort of raises the question: is peak core inflation in, right? What if it's not in? What will that cause the Fed to do? And markets are already speculating on that very matter. We've talked about this before about, what is the Fed going to do? How high will they raise rates? I've spent the entire year listening to people say, oh, they're never going to make it to 2%, they're never going to make it to 3%, et cetera, et cetera, et cetera. And one of the things that I also heard a few months ago is that, they won't raise by 75 basis points again, okay? What's interesting now is that the market has a way of humbling these types of predictions, because the market is now saying it. Not only is there an 84% chance of a 75 basis point rate hike, but there's a 16% chance of a 100 basis point rate hike. When I pulled this up earlier, I was a little confused because I was so used to looking at this, under sort of the idea that when I would briefly look at it, I would say, oh well, it should be like 1684 because there's a much higher chance of the higher one being or higher probability of it being 75 basis points. When I looked at it, I was confused because I'm like, well, inflation came in high. Why would it have flipped? And then I realized it was because the 50 basis point rate hike has now disappeared from the equation. Now, markets are saying there's actually a 0% chance of that happening. You can see just yesterday there was a 9% chance, and a week ago there was a 27% chance, and a month ago there was a 55% chance. Remember, a month ago that was the narrative, that it'll be no more than a 50 basis point rate hike, or it even could be a 25 basis point rate hike if you go back 2 or 3 months. A lot of people were calling for no more than a 25 basis point rate hike at the September meeting. And now that we're here in September and this meeting is only about a week away, markets are now saying 84% chance of a 75 basis point rate hike and a 16% chance of a 100 basis point rate hike. So the reason this sort of changed is because we got rid of the lower one, and now we're actually starting to potentially price in the higher one. And what's interesting is now that there's a 16% chance of a 100 basis point rate hike, you would expect markets to react accordingly, because I doubt markets were pricing that in, right? And there's always the discussion of what is priced in, what is not. A lot of people say, no matter what the Fed does, it's always priced in. But a 100 basis point rate hike is now on the table. I don't think it's the most likely scenario. And clearly markets are saying the same thing. 75 basis point does still seem like the more likely scenario, coming in at 84%. But if you're an investor and you're trying to figure out, well, how do you sort of hedge? How do you protect your capital? How do you go about some form of risk management? You might say, well, a 16% chance of a 100 basis point rate hike was probably not priced in. And now markets might start pricing it in. And you can sort of see that reflected to some degree with the dollar. The US dollar currency index is up 1% on the day, which is a pretty big move for the dollar. And from this wick down here, it's up even more than that. You can see it's up almost 2%, 1.5% or so. So a fairly nice and swift move by the US dollar, constantly reminding us that in 2022, cash really has just been king, and there's no really way around it. And what you'll also notice is during the same time, Bitcoin has, of course, not liked this news, coming back down on the day a little bit. Ethereum is down significantly. The Ether Bitcoin valuation is down quite a bit. And the S&P, which as I'm making this video, it hasn't opened yet, but if I had to speculate, I would guess it is going to come down quite a bit. And we can actually just go look at the futures. Why don't I just go ahead and pull up the NASDAQ futures here. Yeah, you can see it's come down. It's come down about almost 3%. So when I look at this, what I think is that, okay, market participants are getting spooked. Why? Because inflation is not slowing down to the degree that a lot of people thought it was. Okay, core CPI is actually up compared to last month, and it's only 0.2% below the actual peak that we saw earlier this year. So there's no guarantee that the peak for core CPI is even in. We hope it's in, but there's no guarantee that it is. And so markets have, of course, reacted accordingly. And I think, what you're seeing here is now markets no longer giving any credence to the idea of a 50 basis point rate hike, which was once seen as the most likely scenario back a month ago. Now it's saying most likely it's going to be 75. And if it's not 75, it's not because it's 50, it's because it's 100. And 100 would actually be quite the raise, especially, if I just think back to a few months ago, it seemed like everyone was saying that the Fed was done raising rates. And if they did raise rates, they would only raise by 25 basis points or maybe 50 basis points. And now that doesn't even seem like a possibility according to the markets. So these are all things that I think investors should consider with these markets. Will inflation pressures continue to persist for longer than people think they will? And if they do, what are the ramifications of that on financial markets? Now, remember, the financial markets, as long as the Fed is raising rates, it still makes complete sense to be cautious because of the idea of raising rates into a slowing economy. Now, you might think, why doesn't the Fed just stop, right? Why don't they just stop if they're killing the market? They don't care about that, theoretically speaking anyways, right? They don't care about that. They care about inflation. And one of the things I said we'll talk about later on in the video is what happened in the stock market in the 70s when inflation was running rampant. And we've talked about this quite a bit. We'll talk about it a little bit more, of course. But if you go look at inflation and you go back all the way to the 1970s and the early 80s, what you'll notice is that the stock market was putting in fairly lackluster returns over here. As you could sort of see that it kind of stagnated for a while, where we were sort of putting in like lower lows. We were also putting in higher highs, but it wasn't really that great of a market because I guess you could say it was a trader's market, but not really a long-term investor's market, because you could have put money in 63, seen a new high in 65, seen a new low in 67, a new high in 69, a new low in 70, a new high in 73, a new low in 74, and then a new high in 81. Think about that. Just think about that, right? Think about that for a minute. This is what happens when inflation becomes entrenched. This is what happens. A lot of people keep telling me they want the Fed to pivot. And I keep thinking, no, you don't. You don't want them to pivot. Why? Because if they pivot too early, we run the risk of making the same mistakes that we made in the 70s, where the Fed pivots too quickly, markets are filled with exuberance once again, right? And we go up only for inflation to come right back and to sort of squash the dreams of those people that were hoping to continue to grow their wealth by investing in the stock market. Right? These are lessons learned. And, Powell has been fairly clear all year long. Literally all year long, he's been saying, inflation is their number one goal. It's nowhere near where they want it to be. And they will continue raising rates because they don't want to make the same mistakes. I think it's a smart move. I do. I think it's easy to point the finger at people and blame people for certain things and say that they should be doing something different. But he's also in a very difficult position, right? It's a very difficult position to be in. If he caves and shifts back to QE, and if the Fed pivots, while it might appease some people in the short term, it's likely going to lead to inflationary issues for the longer term. So while your current self might like the idea of a Fed pivot, I bet your future self would not. Your future self would probably just say, just get it over with. Let's get inflation back down, and then we can start to go back up again. Look what happened once Volcker got inflation under control, when it started to actually come down. We had a booming market once again. Booming market. Look what happened in the 40s when it finally came down after being relatively stagnant for a while. Another booming stock market. Do you want the Fed to pivot now and for us to more than likely have a period of longer inflation where inflation becomes entrenched for the better part of a decade? Or would it make more sense for the Fed continue to make sure that inflation gets under control, and they will? I think it's going to be somewhat relentless until we really start to see it come back down towards more so the 2% target. Now, could they pivot before 2%? I think they could. I certainly think they could. I think that's the most likely scenario. But I don't think they're going to pivot while inflation still remains 8.3% year over year, right? I mean, if it's moving down, if you see it go for like to 7% next month, and then 6%, and then 5%, and then 4%, maybe then they would, and they will stop raising rates. But how can they stop raising rates when inflation isn't necessarily, especially core inflation, isn't necessarily done going up? I don't think they can. I think they've advertised this for a long time. I think a lot of market participants just refuse to believe them because historically you can't really take the word. You can't really take the Fed at their word. They tend to pivot a lot sooner than people think they're going to. They walk back a lot of what they say, and to some degree, I feel like the Fed has been shamed quite a bit over the last year. And you could argue that that they realize that they've been shamed, and they are now determined to get inflation under control, right? No matter what. We'll see what happens. And I've spent the whole year listening to people tell me that the Fed funds rate can't go above 3% or it can't go above 3.5%. We'll see. I mean, I know anything's possible. The Fed has the ability to pivot at any time, but when markets are now pricing in higher rate hikes rather than lower rate hikes, I think it certainly raises the question: what is to stop the Fed from continuing to raise interest rates for a few more months if core CPI is still going up? And the issue is that even if it comes down next month, right? I mean, there's always a chance that it comes down next month back to say like 5.9% or 6%. That still isn't enough data to assume that the Fed has to pivot. It might be the peak, right? Or it might be the local top, but it still could cause jittery markets for quite some time. So, with regards to Bitcoin, because I know mostly people are interested on this channel in crypto in general, because that's what I mostly talk about. You can see it also doesn't like the news, right? It also doesn't like the news, and I spent so much of my time trying to figure out if we're in this phase, right, where we're just sort of putting in lower highs, or whether we're in this phase where the bottom's already in and we're sort of slowly moving back up. A lot of people think we're over here. A lot of people think we're over here. It all depends on where you measure the top from. I think it makes sense to still be cautious. As I said before, I think it makes sense to still be cautious, especially under the macro conditions that we're currently under. So we'll see what happens here over the coming weeks as the market really starts to price in 100 basis point rate hike. Even though I don't think that's the most likely scenario, markets are now saying it's at least something to consider, right? It's at least something to consider. We'll know soon enough. I mean, the meeting's like a week from now, so we should know soon enough. You can see here it is, September 21st. So 8 days from now, we will have the answer to this question. Will it be 75? Will it be 100? Markets saying 0% chance of a 50 basis point rate hike. I think we'll wrap it up there. I've generally outlined my thoughts, and you can see here the core CPI, so the index for all items less food and energy, rose 0.6% in August. This is after last month where it basically stayed flat. So last month you can see it was flat because previous was 5.9 and then actual was 5.9 for last month. So for the month before this, so for June it was 5.9, then for July it was 5.9, now it's 6.3. So you can see rather than coming back down and continuing this move back down, last month was sort of the warning signal. Hey, it's not coming down anymore. Something just to consider why the Fed is still raising rates. Thank you guys for tuning in. Make sure you subscribe if you're not subscribed. Remember, we do have the Into the Cryptoverse newsletter. We'll be sending out, the idea is to send out like a weekly newsletter, just talking about a few different things. And then also we will be giving away a free subscription every single month, a 1 month subscription into the Cryptoverse Premium, where we actually have not only crypto stuff, we also have a lot of stock stuff as well, equities in general, indices, forex, commodities, that kind of stuff. So make sure you check it out. You can find a link to that newsletter sign up in the description below. That'll wrap it up for the video. Thank you guys for tuning in. Subscribe. See you next time.